Global financial markets are undergoing a profound transformation. After an extended period of low interest rates and easy monetary policy, the tide has turned. Central banks worldwide are raising interest rates to combat surging inflation, marking a significant shift in the global financial landscape. This change has sent ripples through bond markets, with yields rising sharply. Government bonds, once considered safe haven assets, are experiencing heightened volatility. Investors are reassessing their portfolios, seeking higher returns in a riskier environment. The era of low interest rates, which fueled a borrowing binge for over a decade, is drawing to a close. This shift from low to high rates has profound implications for individuals, corporations, and governments alike. For individuals, it means higher borrowing costs on mortgages, car loans, and credit card debt. Corporations face increased expenses for capital expenditures and refinancing existing debt. Governments, particularly those with large debt burdens, are grappling with rising debt servicing costs, squeezing public finances. The global debt-to-GDP ratio has reached unprecedented levels, exceeding even those seen in the aftermath of World War II. This mountain of debt accumulated over years of low interest rates poses a significant risk to global financial stability. As interest rates rise, servicing this debt becomes increasingly burdensome, particularly for countries with weak economies and limited fiscal space. Emerging markets, often characterized by higher debt levels and weaker institutions, are particularly vulnerable to rising interest rates. Sri Lanka stands as a stark example of this vulnerability. The country's heavy reliance on foreign currency borrowing, coupled with a decline in tourism revenue due to the pandemic, led to a severe economic crisis. Sri Lanka defaulted on its debt in 2022, becoming the first South Asian nation to do so in the 21st century. Section 5. The spectre of default, a domino effect. The crisis in Sri Lanka has indeed raised alarms about a potential wave of defaults across other emerging markets, each grappling with similar economic challenges. A sovereign default can unleash cascading effects on the global financial system, leading to a loss of confidence, capital flight, and a sharp decline in asset prices. Given the interconnected nature of global finance, a crisis in one country can rapidly spread to others, underscoring the critical need for timely and coordinated policy responses. Section 6. Energy markets in flux, a new paradigm. The shift in global interest rates is reshaping energy markets as well. Higher borrowing costs mean it becomes pricier for energy companies to finance their exploration and production activities, which could lead to a reduced supply. This comes at a time when energy demand is bouncing back from the pandemic-induced slump. Moreover, the ongoing Russia-Ukraine conflict has further complicated matters, disrupting global energy supplies and pushing prices even higher. Section 7. Navigating the shifting sands investment strategies. In this climate of rising rates and heightened uncertainty, it's essential for investors to remain agile and adapt their strategies accordingly. Diversification across various asset classes and geographies remains key to mitigating risk. Value stocks, which were often overlooked during periods of low interest rates, are now gaining traction as their valuations become increasingly attractive relative to growth stocks. Investing in companies with strong balance sheets and pricing power can also serve as a robust buffer against inflation. As we look ahead, we find the global economy at a critical juncture. The confluence of rising interest rates, high inflation, and geopolitical tensions presents significant challenges. Emerging markets, already grappling with debt burdens and weak currencies, face an uphill battle. However, amidst these challenges lie opportunities. The energy transition presents a significant investment opportunity as countries worldwide seek to reduce their reliance on fossil fuels. Governments worldwide must prioritize fiscal prudence to navigate this challenging environment. Reducing wasteful spending, improving tax collection, and fostering sustainable economic growth are essential to strengthening public finances. and mitigating the risks associated with rising interest rates. International cooperation is paramount in addressing the global debt challenge. Multilateral institutions, such as the International Monetary Fund and the World Bank, play a crucial role in providing financial assistance and technical expertise to countries in need. Coordinated action by major economies is essential to prevent a global recession and maintain financial stability. History is replete with examples of financial crises triggered by excessive debt and rapid increases in interest rates. The Latin American debt crisis of the 80s and the Asian financial crisis of the late 90s serve as stark reminders of the devastating consequences of unsustainable debt levels. These crises underscore the importance of learning from past mistakes and adopting sound economic policies. The global economy is entering a period of heightened uncertainty and volatility. Rising interest rates, coupled with high inflation and geopolitical risks, pose significant challenges. Vigilance, proactive policymaking, and international cooperation are essential to mitigate these risks and ensure a stable and prosperous future for all.